Greetings to the investors of Geojit. Today I am speaking at a time when markets are in crossroad. Last 1 year, Indian economy got caught into a perfect storm. Oil prices moved from 55 to $85. Rupee depreciated from 63 to 74. 10-year yield went up from 7% to 8.25%. Banking liquidity tightened, ILFS default happened, and equity markets corrected far more in small and mid caps than in large caps. Over the last 6 weeks, things started turning around. Oil from 85 instead of going to 100 as expected crashed to 62. Interest rates from 8.25 instead of going to 8.5 came down to 760 as we speak. Rupee stabilized from 74, came to 70. Today it's trading at 72. Equity markets started bottoming out, bounced a little from 10,100 to 10,500 as we speak. But at the same time, there are events which are still going to keep market at crossroad. The big event for market is the political situation. On the day of election results make a big impact. In 2004, markets went down unexpectedly. In 2009, markets went up as they got a different result. But over a period of time, elections don't really matter. In 2004, despite a correction on the day of result, we witnessed one of the biggest rally from 2004 to 2008. In 2009, despite market rising post-election results, thereafter there was not much return to be made. So effectively, election results matter on the day of election. Your portfolios could go up and down by 15 to 20%. But over a period of time, that effect tapers off. What matters is fundamental. What matters is corporate profitability growth. Today in India, we are seeing many steps which have been taken, which hopefully will create a faster economic growth, a better profitability growth. For years, we had suffered from double-digit inflation, high inflation. Now, inflation has been targeted at around 4% level. For years, we had survived or we had suffered parallel economy. With GST demonetization, parallel economy is getting merged into the real economy. There is also a big opportunity coming to India. In 1984, India and China were of similar size. Today, China is 7 times bigger than us. They became manufacturer to the world. We kind of were left behind. Now, US is putting tariffs on goods exported from China, and suppliers from China are looking to move to other countries. In one of the recent article by The Economist, they talked about computers moving to Taiwan, electronics moving to Thailand and Malaysia, food processing moving to Vietnam, footwear moving to Cambodia, clothing moving to Bangladesh. India didn't feature in that. Two of the largest buyers of Chinese exports in US are Amazon and Walmart. Both of them are present in India with multi-billion-dollar investment. What we need is an ecosystem where we can request Amazon, Walmart like large buyers that we give you access to 1.35 billion people market. For providing that access, can you outsource or can you purchase goods from Indian manufacturers? If we can capture the supply chain disruption opportunity, this will be to our manufacturing industry what Y2K did to our IT industry. Is there a initial sign of success that we can capture the supply chain disruption opportunity? The answer is yes. In Indian chemical industry, organic, inorganic, specialty, the manufacturers are growing their market share in the global market, which China is vacating. From 2% market share, we have increased it by 50% to 3%, but China's market share is at 42%. So the journey, which looks like from 2 to 3, looks very impressive at 50% growth, but we have to go all the way up to 42% in order to be comparable to China. So these are some of the opportunities which can be captured by India in coming decade, and that will create great opportunity for Indian corporate sector. The markets in the meantime will continue to go up and down in the near term, led by what happens to oil, what happens to election results. But over a period of time, what will matter is fundamental. Many investors invest during the momentum when the past return of equity looks very, very attractive. 2017 was one such year where small caps delivered almost 40% plus return, mid cap delivered 25% plus return. Today, valuations have corrected. The same small caps are down 40%. The mid caps are down 25-30%. But this volatility is part and parcel of equity market. Equity market is like boxing ring. When you enter, you will get one or two punches. Some of that might be very hard that you will fall down. But as long as you stay in the ring and don't quit, you will make money, you will win the match. The best way to invest in market is via systematic investment plan. It allows you to buy at every level of market, which over a long period of time starts moving upwards. Today, probably many SIP returns will be negative if opened before 6, 12, 18 months. But this is the opportunity to buy things when they are fairly priced rather than when they are expensively priced. This is the time to maintain discipline and continue doing your systematic investment plan, because as and when market recovers post-election results and other uncertainties, your same SIPs will start delivering far better return. If past is an indicator, there are extended periods where SIP returns are negative, but if you maintain the discipline of making investments, not stopping SIPs when the returns are negative, then over a period of time the same SIPs starts delivering far better return. In fact, my request will be, then now when markets are at fair value zone, it's time to increase your SIP allocation. It's time to put more money when valuations have become your friend, and that capturing will be rewarded in the future. I have full belief that India growth story will continue. The steps taken over last 15-20 years in terms of developing our infrastructure, in terms of merging parallel economy into real economy, in terms of creating more efficient economy, has given us a great opportunity to go and capture the supply chain disruption which is coming because of US and China tariff war. This is exactly similar to what Y2K did to IT industry, and we all know how IT industry created wealth. So continue your investment, do tighten your belt as next 6 months will be more volatile, but the disciplined asset allocation and regular investment which you will do, that will eventually reward you. Thank you.